So if you're watching this video, you've probably heard the term asset diversification. It's a pretty big buzzword in retirement planning. But what a lot of people have never heard of, and the term that I prefer to teach people more, is asset dedication. My name's Cody Crawford. I'm with Sound Planning Group, and we're going to get right into it. And I'm going to show you why and how this could potentially impact your retirement in a much greater way. So one of the things that people tell me a lot when they sit with me in the office is they say, Cody, let me tell you what I'm looking for. I'd like to have an account that could never lose money, which is 100% liquid. It could give me double-digit returns. And you know what? It would be great if it was tax advantage. And I say that would be phenomenal. But that's called the Bernie Madoff plan because it does not exist. In fact, everything in the investment world requires a string attached to it. There's no perfect investment, right? So we have to ask ourselves, what are we actually willing to give up in order to get something? And that's why we created the CPR methodology here at Sound Planning Group. And it's really based on these three specific buckets. Here's where asset dedication really comes back into play. What we're trying to do, instead of thinking about diversifying into different positions, what we first want to do is be able to dedicate every dollar to a specific role and function within your retirement plan. Think about this no different than a company. They have different departments, HR, accounting, sales, marketing, because they all have different roles to play. And that's how you should be thinking about your retirement assets. And so that first bucket, what we call yellow money, is going to be your checkings, your savings, money markets, CDs. These are accounts that are going to be liquid, right? You can get at them immediately. You can go to the ATM. They're accessible. Number two, they're protected. You have, number one, FDIC protection from the federal government. But number two, if the stock market crashes, they're not going to lose any money, right? And so why do we use these accounts? What's the purpose of bank accounts? Do we put money in these hoping that we're going to beat Amazon in a race long term? Of course not. These are for short term bills, expenses, emergency reserve. If I have to fix a water heater or put a new roof, we don't want to invest that money, right? Because it could go down if the market goes down. We want to have that in reserve. So what I want you to think about when we're talking about asset dedication now is to put a wall right in between that yellow column, because we want it to kind of be an island in and of itself. So let's go to the next bucket here, which is our protection bucket. This is really the anchor of our portfolios, right? The number one rule behind this green money, as we like to call it, is protection. That means that if the stock market goes down at all, our principal is protected in these accounts. The second is growth. Right? Now, we're not talking about stock market growth. You can see the slide there that says, we're expecting between 5 and 11% in these accounts. So if the market does really well, we do have the potential for double-digit gains. If the market completely goes negative, remember, we get a zero. So in these green money accounts, zero is our hero. We refer to these as indexed linked accounts. It cannot be a green money account if the principal is not protected. Now, what do we kind of give up in these accounts? Remember, this sounds amazing and too good to be true, but we do give up liquidity. So in these accounts, you can generally access about 90% of your capital in an emergency. This is also what we really use, this green money account, if we want to take income in retirement. We've done some videos about sequence of returns risk, which means the last thing you want when you retire is a series of significant down markets, especially when you're having to take money out of your portfolio. With these green money accounts, it allows us to be able to take money from that portfolio, even if the market is at a substantial loss. Now, we may not have made anything at that time, but we're not experiencing reverse compounding or this sequence of returns risk. So again, I want you to think about this as building another bridge or another wall next to this green money column so it can be an island of itself. Why? We don't want to have to take money that we put in reserve for cash and go raid it for anything else. We want specific uses of our money. We want to dedicate each dollar to each component. So let's look at the last one, which is our red money. So let's look at red money. There's only one real purpose to use red money in the way that we plan, and that is for long-term growth to beat inflation. In fact, for baby boomers and your investment careers, Owning shares of the great companies of the United States and the world has been the very best place to beat inflation over time. So growth is the number one rule for these accounts. Again, we're not going to go buy a CD thinking that we're going to beat the S&P 500 in a foot race, right? And so when we're thinking about these accounts and why we would use money in this red column, it's so that we can have long-term compounding and accumulation. The nice thing about these accounts, if you're over 59 and a half, is they should be very liquid. You want to be able to access these. You want them to be flexible, right? So that we can be dynamic in some of the things that we're doing. However, what do we give up in these accounts? Well, we give up protection, right? We know that if we're putting money in Palantir and Google and Meta, there can be some times, especially this early April of 2025, where they get pounded. Now, in our case, one of the things that we use yellow money for over there on the cash side is opportunities. So this might be an issue where we take, opportunity money from the cash account and buy when stocks are low. That's a different video and a different story, but just something to think about. So this is our CPR framework and our CPR methodology. And as you can see, when you look at each of those different buckets, you'll know that there is no such thing as a perfect investment on a product level. But when we're building a retirement plan, we know that if we blend these elements on a portfolio level, we are able to get liquidity, protection, and growth. The question is, for your retirement, how much should I have in each of these components? And it's why I want you to start thinking more in terms of how can I dedicate every single one of my dollars to a very specific role and function within my plan. Remember, what do we use cash for? Yellow money. It's to pay bills, to have emergency expenses, and maybe some opportunities. What do we use the green money for? Number one, preservation of capital. Preservation of capital. It also gives us moderate growth, and that's where we're really going to use this bucket to fund our income in retirement. I also like to say this is for sleeping at night, because ultimately, retirement is about being able to lay your head on your pillow at night and have peace that your money is safe, or at least a good chunk of it is safe. Now, to the red money or the risk money, what do we use this for? Long-term growth to beat inflation. Number two, probably some legacy, right? You want to be able to maybe leave an intentional amount to your heirs long-term. I don't know, maybe you want to do it now, but legacy is a big component of that. And then number three, it is to ultimately hit home runs. We never, as a general rule of thumb, want our portfolio to be soaring or diving at any one time, because we don't want to bet on one idea, right? You probably don't want to just put all your money in Bitcoin. God bless those people who have, and it turned out well. But for a prudent retiree, probably don't want to look at it like that. But again, we'll blend these three for your retirement plan. And what we end up getting is a dedicated asset allocation so that we can have the right liquidity, we can have the right protection, we can generate our income, and we can beat inflation over time. That is the CPR framework, the yellow money, the green money, and the red money. And again, it's what I want you to try to take out of this is not so much how do I diversify between stocks, bonds, mutual funds, real estate. The first thing we think every retiree should do, and here's what we help our clients with, is how do we identify each dollar, give it a very specific role, function, and purpose so that when you come into retirement, you know that you've got liquidity to pay your bills. You've got your emergency cash position. You've got maybe some money for opportunities in case the market goes down, right? We can buy low instead of, selling high. In the green column, this gives us our preservation, the anchor. We know that the money in this account cannot lose anything. It allows us to sleep at night. But we also know we can come in and we can generate predictable, consistent income from this green money bucket. And then the red money bucket is what gives us our long-term accumulation, beat inflation. We want these to compound, and we really want this not to be touched for as long as we can. We know the market goes up and down, but long term, it has always gone up. So if we can let that continue to compound without rating it for our income, then in 15 and 20 years, you'll probably have double what you started with. Now, past performance does not equal future results, but it gives us the best opportunity and probability to do that. So I hope this video helped. I hope it gives you a new framework on how you might want to look at dedicating your assets and building your own CPR methodology. As always, hit the link in our description at myspg.com. If you need help or have any questions on how to do this on your own, just let us know. Have a great day, and I hope to see you on the next video.